So I think about this a lot. I mean, what makes a great investor? Are you tired of mediocre returns on your investments? Do your dreams of becoming a successful investor fade? Do other people tell you that it's not possible? So in this video, what I want to do is I want to reveal some of the key traits and the strategies that go along with that separate a great investor from, well, the rest of them. So stay tuned and learn how you can take control of your financial future by taking control of your money and your mindset. So all the things that I've learned by being a financial advisor for 16 years, by being a professional investor, options trader, and all the stuff that I've done is this one thing. A great investor does not make emotional investment decisions. They make logical decisions based on a set of firm rules that they created, which has resulted in calculated decisions and calculated returns. So let's dive into that a little bit. Let me ask you all a question. When you trade or when you buy anything to invest, right? When you buy a stock, you buy a bond, maybe you buy real estate, do you have a set of rules for which you want to follow? And let me break that down even further. When you buy an investment, you know what the expectation for your return is. Do you want to make 10%? 20%? Is it 30%? Are you shooting for the moon? What is your rules that you follow? Let me talk a little bit about mine. And I'm going to start with real estate. So back when I was flipping houses, we had a firm set of rules for each property that we bought. Because in real estate, as I said in my other video, the money's made on the buy. But that firm rule was every house that we were going to flip, our minimum return was 20%. So if we hit 20%, we were happy. If we made more, that was great. If we made less, we had some things to learn as to why we didn't hit that. Now let me go over to options trading. I had a firm rule with options trading. If I made 10%, I was out. And I only did intraday trading for options, which meant I only traded during trading hours. I never held overnight. There was a couple rare occasions where I did, but my expectation was I wanted 10%. And I also set rules when I traded options and even stocks that I had a downside rule. So I was only willing to lose 5%, which isn't a lot. I got taken out of a lot of deals using stop losses way before I should have been taken out because I set my rules. Now you can adjust your rules. Maybe your upside's I want to make 20 and your downside is I'm okay losing 10. Great. Set those rules and trade like that. How about in your 401k? This is a little different. What are your expectations? What is your desired return? And everybody says my desired return in my 401k is I want to retire someday. Great. What does that return look like to get that? How much do you need to make every single year in order to fulfill your retirement goals? Okay? Are your retirement goals $5,000 a month, $10,000 a month net? If it is, are you adjusting for inflation? What inflation number are you using? Is it 3, 3.2, or 4? All the numbers we used to use as advisors? Well, that means that every year you need to make more money to offset the inflation that you're fighting against. But most people don't trade with any rules. They just trade on emotional-based decisions. Professional, good traders do not do that. Mark my words, they do not trade the way that you trade. They have rules and they have limits, and you should too. Number 2, professional traders, okay, good investors, they don't let their emotions get the best of them. They make rational and calculated decisions. And what are those rational and calculated decisions? Well, let's look on the buy. If they're looking at a real estate investment, they're going to make calculated decisions based on pro formas, based on set rules that they've come up with. And because of those rules and those pro formas, those calculations, they make a rational decision. This property makes sense, or this property doesn't. Let's walk away from it. I do this all the time, and I've walked away from some unbelievable real estate deals. Ones I should have never walked away from, but my rules are my rules. And although my rules make it so that I can't get a lot of the properties that other people would salivate over, that's what it is. So I don't make emotional-based investment decisions. I make logical, rational, calculated decisions, and so should you. When you buy a stock, what is your rational, calculated decision for buying that stock? Is it that you just love the stock, or did you study their financials? Did you look at their earnings reports? What calculated decision did you make that led to you buying that stock? I don't know. Have you ever thought about that? When you buy crypto, this is a tricky one. Why did you buy what you bought? I bet you most of you can't even answer that. You just thought, well, I wanted to make a lot of money. That is an emotional-based decision. That is not a rational decision. So please go back to the drawing board and think about this. Listen, not all of you are going to take this advice, but if you don't, understand the downside is you're going to lose a lot more money than all the other ones that do make rational, calculated decisions. And the ones that make rational, calculated decisions over a long span of time, even a short span of time, they're going to make a lot more money than you are, because they have rules and they make these decisions based on not emotions, but logic. Number 3, they definitely don't do this. Professional, and I hate to keep using that word professional traders, but I'm always leading with that, but just successful investors. They don't blindly throw their money at any investment. They carefully evaluate. They look at the prospectuses. They look at the PPM. They look at the subscription agreement. If you don't know what any of those are, that's okay. But they look at the fundamentals. Why, beneath the surface, beneath the hype, beneath the advertising, why is this a good investment? They evaluate that. And not only that, they look at the risk-reward profile. How much risk am I willing to take to get the desired return? Return. How much risk for how much return? I'm willing to take 5 or 10% risk to make a 20% return. That's a good metric. Well, those are potential risk versus reward profiles, and you should know yours. Now, if you're getting close to retirement, I was on the phone with a woman yesterday and her husband. He's retiring in 9 years. And his advisor, I hate to say this, his advisor suggested he put his money in this target date fund, which was way outside of his risk return profile. And I had him on the phone for 5 minutes, and I knew what his risk return profile was. And I said, well, why did your advisor tell you to put money in this? And he gave me the answer. I said, did he not listen to what you said? You basically just told me you can't afford to lose money. You want to retire in 9 years. You're scared that the markets are going to go down. You can't afford to lose money. Well, he put you in something that absolutely is going to lose money. And he told you that you had enough time over 9 years to make good. I'm telling you that that isn't the case. Now, some of that could be semantics. Some of that could be personal opinion. But you know what? It comes down to the factual thing that advisor did not listen to his client. That's a shame. How many of you have advisors or people in your corner that you call them your team that are not listening to your risk-reward profile, that are not listening to what your needs and goals are and how much risk you want to take and how much you want to make or what your end goal is? Do they even know? So I don't mean to beat that one to death, but that is very important. Number 4, successful investors aren't afraid of market fluctuations. They know how to navigate through them. Let me give you an example. A successful investor might have a position. Let's just say they own a stock like Apple, but they protect the downside, okay? They protect the downside maybe with puts. They know how to do that. Maybe their downside is protected with a stop loss. That's super easy. That means that if Apple goes the wrong direction, they got a stop loss. It just sells the position. That's why they're not afraid of market fluctuations. If they didn't have that stop loss or they didn't have that put option to protect downside risk, then of course they would be afraid of market fluctuations, but they're not because they know how to navigate them. Do you know how to navigate market fluctuations? Most people know how to make money when the market goes up, and that is it. But what happens when the market goes sideways like it has been? We're in January 2023. Do you know how to make money when a market's going sideways? Do you know what covered calls are? Do you know what straddles are? Do you know what all the different strategies are that you can use? Probably not. Get somebody to teach you how these work. Now, the last question on this one is, do you know how to make money when the market goes down? Well, that would be fun, wouldn't it? If you knew how to make a bunch of money when everybody else is losing money? Yes. That's why successful investors aren't afraid of market fluctuations. It's not that they're not afraid of losing money. It's that they know how to navigate it. You need to know too. And we're not getting into the weeds on this, but I have other videos on my YouTube channel. So just subscribe right now to this video. Okay, subscribe to this channel. Right at the bottom, there's a little red thing. It says subscribe. Hit that button. And right above that, there's a little bell, maybe left or right side. Hit that bell. That'll notify you every time I put new videos up. And I put a video up every single day. So if you don't know what I'm talking about with this stuff, well, I guarantee you there's a video. Just put it in. Search for it. Let's carry on. Number 5, successful investors, they never stop learning. Hence what I just said before. They never stop learning. If they don't know something, they learn. There's a YouTube video for everything these days. And if there's not a YouTube video, there's a course out there to teach you how to do this. Anything else, you're just making excuses.
Oh, I don't have time. Oh, no. I'm not smart enough.
No one's smart enough until they are smart enough. And you know what smart enough means? You got educated. You learned. You spent the time to fix this. Your brain can hold it all. Don't ever tell me you're not smart enough. I could say I'm not smart enough, but I've taken the time to learn, and all successful investors do the same thing. They always look for ways to improve their investment skills. So folks, we just covered 5 unbelievable traits and unbelievable things that successful investors do. Let's recap them real quick. Number 1, great investors don't make emotional investment decisions. They make logical decisions based on a set of rules. Number 2, they don't let their emotions get the best of them. They make rational, calculated decisions, and you absolutely need to do that. Number 3, they don't blindly throw money at any investment. They evaluate investments, and they look at the risk-reward profile that they set. And risk versus reward is one of the most important things you need to know about you. Number 4, they're not afraid of market fluctuations because they know how to navigate them. Do you know how to navigate an up market, a down market, and a sideways market? If you don't, time to start learning. And number 5, they never stop learning. Just like I just said, they never stop learning. They're always looking for ways to improve their investment skills. Folks, these are 5 unbelievable things you need to start learning. And you need to spend a little more time than just this little 12-minute video, because these things will change your financial future. And not only that, if you like this video, check this one out. How important are interest rates? This is another thing you need to know. So watch that video and start learning. Thanks for joining me. We'll see you on the next one.